The jobs report came out on Friday morning, and the U.S. added 850,000 non-farm payroll jobs, up from 700,000 that was initially forecasted. Jim Wyckoff, senior analyst at Kitco News, joins us now to talk about the impacts on the markets of these numbers. Jim, welcome back to the show. Great to have you every week. What do you make of this reading, and how did gold react this morning?
Good morning, David. Well, the initial figure of 850,000 in non-farm payrolls seemed upbeat. And gold actually in the seconds after the report was released downticked a little bit. However, the internals of the June jobs report were not so upbeat, and I think the markets are focusing a little more on that. The unemployment rate ticked up a little bit. The participation rate in the workforce is only like 61% and change, and that's kind of, that's not upbeat at all. So I think what the marketplace is deeming for today's jobs report is that maybe the Federal Reserve can't start tapping on the brakes on monetary policy quite as soon as maybe some had reckoned.
Mm-hmm. And it's interesting how gold ticked up a little bit. We're up $17 as of 9 o'clock Eastern time. The equities markets haven't opened yet. We're speaking ahead of the bell. What do you think is going to happen?
Well, by looking at the pre-market trading in the stock indexes, we're going to see higher openings. What the report suggests, or what I think what traders the past couple of jobs reports have been thinking is that they've been thinking there's going to be a surprise on the upside on a strong report, maybe even a really strong report. So I think the fact that today's report kind of routine or mundane, not really strong, not really weak, that kind of assuaged those that were thinking that a strong report might really fall into the camp of the monetary policy hawks to get these interest rate increases coming sooner. And that didn't happen. I think the gold market bulls kind of breathed a sigh of relief. You saw some more short covering like we've also seen this week. You saw the U.S. dollar index tick down a little bit as we speak. And that's also been supportive for the metals markets.
Jim, the 850,000 jobs that were added, that beat the initial forecast of 700,000. Were you surprised that we beat consensus this month, considering that people were talking about labor shortages?
No, not really, because what we've seen the past several months in these non-farm payrolls numbers is that they've been hard to forecast. The economy is really springing out of the pandemic. So there's been a lot of misses on the non-farms numbers. So today's upside miss was not a big surprise.
Okay. And going forward now, let's talk about gold and silver before we talk about the rest of the economy. $1,700 to $1,800 rather. That's the range we've been seeing for the last while. Do you expect us to break out of this range anytime soon?
I don't know. We'll just have to see. We've been trading sideways and choppy the past couple of weeks. Now, the bears still have the near-term technical advantage in both gold and silver. That suggests a sideways to lower bias for the market. So I suspect that's going to be the case until we see some kind of a strong technical clue to suggest the markets are going to break out to the upside. And as I've said before, the Kitco readers and listeners are going to get those technical clues by reading my AM and PM reports.
Okay, and silver as well. We haven't seen $30 in a while. So when are we going to see that, Jim?
Well, I think we're going to see it, and we may see it yet this year. But again, I think we've got to get through some turbulence and some rough waters here in the near term to turn this near-term technical posture around. Mm-hmm. Because the longer-term technical postures for both gold and silver remain in the bullish camp. So I think we might plod a little bit longer here. But then I suspect come fall, heading into the end of the year, you're going to see higher gold and silver prices.
And Jim, do you follow the futures markets for both gold and silver for clues as to what traders are doing right now?
Oh, absolutely. I do. And the charting capabilities for the futures markets are much stronger in my mind, give better technical clues than do the cash prices. So I follow. In fact, the Kitco readers know that when they read my analysis that I am quoting the futures prices.
And how are traders positioned right now? What do you think sentiment is right now in the marketplace?
Well, the sentiment right now is leaning slightly bearish, and you can see that by the sideways price action. We're still in price downtrends on the daily charts for both gold and silver, so sentiment is a bit bearish right now.
If you were to speculate that gold needs to go higher, then what needs to happen really with the economy? Would you expect, well, would you need to have a weaker jobs number instead that could possibly prompt the Federal Reserve to take action?
You know, this answer might surprise you, but I really don't think it makes a whole lot of difference for the near term, and I'll tell you why. Commodities are highly cyclical, and I think you are in a longer term upswing cyclically in the raw commodity sector. We've seen we've seen crude oil prices this week hit a 2.5-year high. We've seen copper is not far below its recent 10-year high. So I think you're seeing a cyclical upswing. And David, you can argue when these numbers come out, these economic numbers, you can argue that this report should be bullish for gold or should be bearish for gold. And those arguments are made. But I think the important thing to keep in mind is the day-to-day machinations of the markets should be put in perspective and viewed at least occasionally from a longer-term perspective. And the longer-term perspective on gold and silver, the longer-term technical posture remains friendly.
Okay. And would anything change your mind for the longer-term perspective if you were to see data that could suggest a different thesis? Would you consider a more, let's say, unfriendly posture for gold and silver?
Yes, let me tell you what that would be. If the pandemic had a unexpectedly strong resurgence and shut businesses down again around the globe, that would be a demand shock to the raw commodity sector, including gold and silver. That would really probably push prices solidly lower. Now, the bulls might be able to argue that could prompt some safe haven buying, and I suspect it would. But I think on an overall basis, I think the lower demand that would occur in such a scenario would trump the any safe haven buying. But that being said, I think that's a very unlikely scenario. Much more likely is we're going to continue to spring out of this pandemic. Demand for raw commodities is going to continue to climb, and that's long-term bullish for gold and silver.
Excellent. And you brought up oil. What's your view on oil for the rest of the year, and how does that relate to gold? Well,
oil is a very important outside market for many commodity markets, including the metals. Crude oil prices are trending higher. Above $75 a barrel in NYMEX crude has been surprising to a lot of people in the marketplace, including me. Those people a couple of months ago that were thinking that were buying call options with $100 strike prices on NYMEX crude were kind of laughed at by some in the community. But as we speak today, that $100 level is not so far-fetched. I still doubt we get there, but those guys that have those $100 call options, they're thinking prices are going to keep climbing, and right now the path of least resistance in crude is sideways to higher.
Mm-hmm. Excellent. All right, Jim, we'll follow up with more updates the following week. Thank you so much for coming in today to give us your updates on this Friday, very important day for our jobs numbers. Thank you again.
You bet, David.
And thank you for watching Kitco News. If you're watching on YouTube, don't forget to subscribe and follow me on Twitter at DavidLin_TV and DM me if you have questions. I'm David Lin. Thanks for watching.